Welcome to vTalkInsight, Allocator's Lens Daily for March 25th, 2026. A stubborn Gulf energy shock, elevated volatility, and higher bond yields are now colliding with still robust earnings and powerful AI investment themes. For cross-asset allocators, the key question is how long this fragile balance between risk-taking and stagflation fear can hold. In equities, the tension between strong fundamentals and tougher macro conditions is becoming more obvious by the day. Earnings growth into 2026 is still described as robust, not only for large technology names, but across a broader swath of the market, with 12-month forward estimates for the S&P 500 projected to grow around 16%. Yet those earnings are being capitalized at roughly 20.5 times forward profits. So recent equity weakness has largely come from valuation multiples compressing rather than earnings rolling over. Technically, the S&P 500 has broken below its 200-day moving average for the first time since last May, and the average stock has seen a drawdown closer to 17% versus only about 7% peak to trough for the index itself. Under the surface, investors are rotating hard. Energy, materials, and even coal stocks have been bid up as markets seek beneficiaries of prolonged commodity disruptions, while basic resources and banks are lagging and airlines are seeing margins squeezed by sharply higher jet fuel costs. Liquidity has also thinned, with a growing share of daily volume running through exchange-traded funds and signs that inflows into United States equities are fading in favor of more international exposure. At the same time, secular themes around artificial intelligence continue to provide powerful support for selected segments of the equity market. Spending on AI infrastructure is expected to reach into the trillions of dollars over the coming years, driving demand for cloud platforms, chip designers, and the utilities building new generation capacity to power data centers, including projects shifting from the Middle East toward energy-secure regions like Texas. That backdrop, alongside a rotation into quality balance sheets and strong cash flow names, has kept dip buying behavior alive, with allocators still adding to broad equity exchange-traded funds even as they trim United States equity overweights back to more neutral stances. From here, the interaction between higher long-term yields, elevated energy costs, and the durability of this AI-led earnings story will be critical, especially as markets flag a move above about 4.5% in the 10-year yield as a potential tipping point for equity risk appetite. Turning to rates, bond markets are digesting a fresh inflation bump from the energy shock at the same time as growth signals soften. Yields across the United States Treasury curve have rebounded, with 2-year yields briefly touching around 4% and 10-year yields moving into the low 4.4% area, and some market participants highlighting that a sustained move beyond roughly 4.5% could force a broader reassessment of equity valuations. Headline United States inflation is now expected to rise by about 50 basis points this year, peaking near 4% around May before easing back toward 3.7% by year end as the one-off impact of energy fades. Central banks are walking a difficult line. The Federal Reserve is seen as likely to stay on hold near term, focusing on maintaining liquidity and waiting for clearer data, even as expectations for cuts recede after a weaker Treasury auction and still firm price pressures. In contrast, the European Central Bank and Bank of England are being repriced more hawkishly as higher input costs in purchasing manager surveys and rising energy bills raise stagflation concerns, particularly in the United Kingdom, where debt levels are high and funding costs are already elevated. Despite this, some allocators view the recent rise in yields as starting to create value, especially in the 10-year and shorter part of the curve, where levels around 4.4% are seen as compensating for the expected path of inflation. They also point to disinflationary forces from flat house prices and modest rent growth that could eventually offset commodity-driven price spikes. Mortgage-backed securities, offering 30 to 50 basis points more yield than treasuries and relatively stable credit quality, are cited as one way to seek income amid rate volatility. The complication is that the traditional negative correlation between equities and bonds has turned positive again, so rate risk is no longer a straightforward hedge for equity risk, making the next moves in yields particularly important for multi-asset portfolios. In credit, the fault line between private and public markets is widening. Private credit vehicles are facing mounting stress, with some large managers capping withdrawals at around 5% after redemption requests exceeded 11%, and others relaxing their normal gates in an effort to maintain confidence. Ratings downgrades, including a move to junk status for a business development company facing persistent asset quality issues, and concerns that default rates in some private portfolios could exceed 20% over the next few years, underline the combination of weaker underwriting standards and liquidity mismatches. By contrast, public credit indices still look relatively orderly. Investment-grade 5-year credit default swaps have widened by roughly 15 to 20 basis points month to date and high yield by about 40 to 50, signaling higher risk but not outright stress. New issues in both investment-grade and high yield have been oversubscribed, and all in investment-grade yield around 5.25% are drawing steady demand, even though spreads themselves remain historically tight. Convertible bonds are being used by some allocators as a way to maintain cyclical and equity sensitivity with embedded downside protection, while alternative assets with genuinely low correlation have offered better diversification than long-only private equity or private credit so far in this shock. Across foreign exchange, the dollar remains firm, but the composition of safe havens is shifting. Persistent geopolitical risk in the Persian Gulf and the United States' relative energy insulation are keeping the dollar resilient, even as its role as a pure stagflation hedge is less clear now that Europe and the United Kingdom are also tightening policy. Some see traditional havens like the Swiss franc and the yen becoming more attractive if global recession risks rise, and Japanese policymakers are already signaling discomfort with yen weakness and imported energy inflation, hinting at potential intervention. The strains are most evident in vulnerable importers, with the Philippine peso hitting repeated lows against the dollar as authorities hesitate to burn reserves and in assets that were once sold as alternative havens. Bitcoin has traded increasingly in line with the S&P 500 over the past year and fell alongside equities during the latest Middle East flare-up, undermining its safe haven narrative. Gold, too, has struggled to provide diversification as a stronger dollar and rising yields weigh, leaving cash as one of the few assets reliably holding its value in recent risk-off episodes. At the same time, institutional interest in digital infrastructure is deepening, with major banks applying for digital asset custody charters and spot Bitcoin products, and technology providers reporting resilient demand for secure storage solutions, which could shape how currency and crypto exposure is managed over time. Commodities and energy in particular remain the fulcrum of the current macro regime. Conflict in the Middle East, involving Iran and the risk of broader regional participation from countries like Saudi Arabia and the United Arab Emirates, has taken on a more structural tone, with genuine damage to oil and gas infrastructure rather than just temporary flow disruptions. Estimates suggest that up to 15 million barrels per day of oil supply remain offline, while liquefied natural gas shipments through key choke points have been cut enough to remove around 20% of available supply, with force majeure potentially lasting years at some facilities. Brent crude is holding above $100, and many observers now see a lasting risk premium embedded in prices, with the long-run baseline shifting from around $60 a barrel towards something closer to $80. Scenarios remain wide. If the Strait of Hormuz stays heavily constrained and tension spread, prices could revisit the $120 to $125 area and even spike toward $150 if disruptions persist into April, especially if Houthi forces escalate attacks on regional infrastructure, as some assign a greater than 50% probability. Restoring balance will likely be slow, even under a ceasefire, because damaged assets need repair and inventories of specific crude grades and refined products must be rebuilt. This energy shock has clear macro spillovers. In Europe, gas storage is estimated to be about 30% below last year's levels, leaving the region vulnerable to price spikes and raising the risk of stagflation. While in Asia, some countries are restricting exports of refined products like diesel and jet fuel to protect domestic supply, contributing to shortages and severe margin pressure for airlines. The United States economy is more insulated thanks to energy independence, with an average oil price in the low 80s expected to shave only a modest amount from gross domestic product. But globally persistent high energy costs could still erode real incomes and eventually force central banks to prioritize growth over inflation. At the same time, tight liquefied natural gas supplies are driving renewed demand for coal, supporting related equities, and accelerating investment in renewables, storage, gas and nuclear capacity as utilities race to add 15 to 30 gigawatts of new generation by the mid-2030s to power data center expansion. Pulling it all together, the cross-asset picture is one where a genuine Gulf energy shock and higher yields are colliding with still strong earnings and powerful AI-driven growth themes. Equities are caught between rich valuations, rising input costs, and attractive long-term profit stories, while rates now embed an energy-related inflation bump and much less confidence about near-term Federal Reserve easing. Credit markets show stress building in semi-liquid private vehicles, even as public investment grade and high yield remain relatively well bid. And in currencies, the dollar stays firm, but with growing pressure on vulnerable importers and little evidence that gold or Bitcoin are acting as reliable havens. The fulcrum remains commodities, where the duration and severity of oil and liquefied natural gas disruptions will go a long way toward deciding whether this period resolves as a contained soft landing or drifts further towards stagflation. For allocators, the key signposts are the path of Middle East diplomacy, the behavior of 10-year yield around the 4.5% area, evolving liquidity conditions in private credit, and how far the energy shock bleeds into broader inflation and growth data. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.